The United Nations is forecasting lower global economic growth for 2022 and 2023. Lou Zenman, the UN Under-Secretary General for Economic and Social Affairs, said at a news conference on January 22nd that we are still living in a time of great uncertainty. After expanding at 5.5% rate in 2021, the highest rate for global economic growth in more than 4 decades, the world economy is projected to grow more slowly in 22 and 23. He added, at the start of 2022, the global economic picture in the market is still very murky. For the first time in a very long time, January showed investors that the stock market doesn't always rise. Huge intraday gyrations and daily swings of 1,000 points or more have been more frequent this month. Investors will see monthly statements at a loss. While the daily market movements have been large, the first month of 2022 will end with the S&P 500 down less than 5%. All assets, including stocks, bonds, and real estate, have been hit hard. To explain the volatility we're seeing, it might be helpful to use an analogy. Think of a patient that gets into a car accident and needs a significant amount of medication. At some point in the future, as the patient recovers, it'll be necessary to withdraw and reduce the meds. Similarly, when the pandemic started, the Fed jumped into action and gave the financial markets and the economy a tremendous amount of medication by lowering interest rates and quantitative easing programs. Essentially, the government was pumping money into the system to keep markets liquid and functioning normally. Now that the economy is in recovery, the Fed is beginning to taper the medication. We should expect withdrawal symptoms as the government begins to wean the economy off the stimulus. Economies always exhibit volatility as a normal reaction to any change in Fed policy. To exacerbate matters, inflation has reared its ugly head, rising at its fastest pace since the 1970s, necessitating the need for the Fed to reduce medication even faster than it might normally have planned. Other areas of concern to investors are the earnings outlook and guidance have been mixed, but generally weaker than hoped. Supply chains are still a mess. Tech and high growth stocks have been beaten down because these industries are typically more sensitive to rising interest rates. And the majority of indexes are heavily weighted in big tech, so when big tech drops, so do the indexes. Our opinion is that the current market behavior, including the January drop, is a healthy and normal part of the historic and typical market patterns and economic cycles. The steady rising market we experienced from April 2020 through December of 2021 and the lack of volatility is what's really abnormal. We believe that volatility will likely continue until more clarity from the Fed is achieved and valuations become more stable. Our portfolios are well positioned for the current market volatility. In anticipation of this, we proactively took steps late last year to rebalance our portfolio in the following ways. We increased our allocation to commodities in anticipation of rising inflation. We sold off some of our large growth stocks to lock in profits, and we increased our allocation to large value stocks because large value stocks generally perform better during times of rising interest rates. We increased our allocation to hedged equities, providing additional downside protection for our portfolios in the event of a market correction, and we reduced bond sensitivity to interest rates by investing in shorter-term bonds and floating rate funds, both of which perform better when interest rates rise. The rebalancing steps that we took late last year are doing exactly what they were designed to do: reduce volatility in your portfolio and preserve capital. We'll remain vigilant in monitoring these market developments and adjust our holdings as necessary. If you have any questions, feel free to call or email us at the office. And as always, thank you for your ongoing trust in Simmons Capital Group and our entire team. Thank you.